March 2008. I lost $20,000 on a single stock in 6 months. A dry shipping company. The stock looked cheap. I thought I'd found a bargain. I was wrong. Here's what kills me. The warnings were right there in the financial statements. I just didn't know what to look for. Today, I'm going to show you 7 red flags that scream, avoid this stock. These aren't complicated. You can check them in 15 minutes. And they'll save you from the kind of disasters that blow up portfolios. First up, gross margin. This is the simplest and maybe the most important metric you'll ever learn. Gross margin tells you how much money a company keeps after paying for the direct cost of making whatever they sell. Take revenue, subtract the cost of goods sold, divide by revenue. You get a percentage. If that percentage is below 10%, run far away. Here's why this matters. A company with gross margins below 10% is basically saying, for every dollar we make, we have to spend 90 cents just making the product. That leaves almost nothing for everything else. Rent, salaries, marketing, research, debt payments, all of it. These companies are on a treadmill. They're sprinting just to stay in place. Let me show you what this looks like in the real world. Pull up Walmart's latest 10K. Walmart, the biggest retailer in America. Their gross margin, around 24%, which sounds decent until you realize what they're working with. After all their operating costs, their operating margin sits at just 3 to 4%. Now, look at Costco. You think a membership model would give them breathing room, right? Nope. Their gross margin hovers around 11 to 13%. Even thinner than Walmart's. They make most of their actual profit from membership fees, not from selling you that giant jar of mayonnaise. These retail giants operate in a brutal business. One competitor drops prices on eggs and milk, and suddenly you're in a race to the bottom. When your margins are already that thin, you have zero room for error. A supply chain hiccup? A spike in transportation costs? Tariffs? Your entire quarter's profits just evaporated. Contrast this with software companies like Microsoft. Gross margins around 68 to 70%. They build the software once, sell it 1,000,000 times. High gross margins give them room to breathe, room to make mistakes, room to invest in growth without immediately going broke. Bottom line, if gross margin is below 10%, the business model is probably broken. You're looking at a company where one bad quarter can spiral into disaster. There's just not enough cushion for anything to go wrong. And trust me, something always goes wrong. Revenue is just how much money the company brings in from sales. Revenue growth is whether that number is going up or down year over year. If it's growing slower than 2% annually, that's barely keeping up with inflation. That company isn't actually growing, it's treading water. Now, there's an important caveat here. If you're looking at a massive, mature company like Coca-Cola or Procter & Gamble, slow revenue growth might be fine if they're paying huge dividends and buying back shares. They're cash cows, not growth stories. But if you're looking at a company that's not paying substantial dividends and revenue growth is under 2%, you have to ask, why own this stock? Let me show you what this looks like in practice. Take a look at Intel. When you pull up the last 3 years of revenue, you'll see that 2023 revenue was $54 billion. 2024 dropped to $53 billion, and 2025 came in at $53 billion. That's not slow growth. That's actual decline. Meanwhile, their competitors, AMD and NVIDIA, were growing double digits. Intel kept talking about their turnaround plans, their new chip manufacturing strategy, their commitment to innovation, but the numbers told a different story. The stock has reflected that reality. Here's the brutal truth. Companies that aren't growing probably won't start growing. The business environment is competitive. If a company can't find ways to increase sales by at least a few percentage points a year, there's usually a structural reason. they've lost their competitive edge. Or management is asleep at the wheel. When you're looking at stocks, you want companies that are doing something, expanding, innovating, taking market share. Revenue growth below 2% means none of that is happening. That's revenue growth. But here's where things get really interesting. Red flag number 3 catches companies that are straight up lying to you, or at least being creative with the truth. Look at these two numbers: net profit and cash from operations. Net profit is what the company reports as earnings. It's on the income statement. This is the number that gets all the attention. Cash from operations is on the cash flow statement. It shows how much actual cash the business generated from its core operations. If net profit is significantly higher than cash from operations, something sketchy is going on. Because here's the thing: profit is an accounting concept. Companies have lots of flexibility in how they calculate it. They can change depreciation schedules, play with inventory accounting, and recognize revenue in creative ways. But cash is real. Cash doesn't lie. Let me show you a real example. WeWork before its spectacular implosion in 2019. You pull up their S1 filing, they're reporting something they called community adjusted EBITDA. Basically, their own made-up profit metric that made them look profitable. But flip to the cash flow statement. Cash from operations was massively negative. In the first half of 2019 alone, they burned through $1.4 billion in operating cash while trying to convince investors they had a path to profitability. How? They were recognizing long-term lease commitments as revenue upfront while spreading the cost over years. They were capitalizing marketing expenses and calling it growth investment. Basically, they were making the numbers look good while hemorrhaging actual cash. The IPO collapsed. The company nearly went bankrupt. Investors who believe the accounting games instead of the cash reality lost billions. Now, to be clear, there can be legitimate reasons for this gap. Maybe the company is growing fast and needs to invest in inventory. That's fine occasionally. But if it's a consistent pattern, if profits are always higher than the operating cash flow year after year, the company is playing games with the numbers. And eventually, reality catches up. Always check the cash flow statement. If cash from operations doesn't support the reported profits, walk away. Now let's move to red flag number 4, EBITDA, which tells you if a business has any breathing room at all. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a mouthful, but here's all you need to know. EBITDA tells you how profitable the core business operations are before all the accounting stuff and financial engineering. Calculate it by taking EBITDA and dividing it by revenue. If the percentage is below 3%, the business barely makes money from its actual operations. This is different from gross margin. Remember, gross margin is what's left after direct costs. EBITDA is what's left after operating expenses too. All the salaries, rent, marketing, everything except interest, taxes, and depreciation. If EBITDA is below 3%, the company has almost no breathing room. A small increase in costs or a small decrease in sales, then they're losing money. Take the restaurant industry. Many casual dining chains operate with EBITDA between 5 to 8% in good times. During COVID, when capacity restrictions hit and costs stay fixed, chains with already thin margins saw those numbers collapse to 2% or worse, sometimes negative. Chipotle, despite being a powerhouse brand, reported EBITDA around 1 to 3% during the pandemic's worst quarters in 2020. That's essentially zero cushion. When your margin is that thin, you can't absorb any shock. Reduced traffic, higher labor costs, supply chain issues, any one of these pushes you into the red immediately. Compare this to great businesses. Apple has EBITDA around 30%. Microsoft is similar. Even in tougher industries, healthy companies usually have EBITDA of at least 10%. Below 3%, the business is fragile. One bad quarter, one unexpected cost, One economic downturn, and they're in trouble. Don't bet on fragile businesses. There are too many strong businesses out there to waste money on the ones that are barely profitable. Speaking of thin margins, red flag number 5 takes this even further, looking at what's left after absolutely everything. This one's closely related to EBITDA, but even more brutal. Net margin is percentage of revenue that actually becomes profit at the end of the day, after everything: cost of goods, operating expenses, interest, taxes, all of it. If net margin is below 1%, the company is keeping less than 1 penny out of every dollar it makes. If they have $100 million in revenue and a 0.5% net margin, they're making $500,000 in profit. That's nothing for a company doing $100 million in sales. These companies are one problem away from posting losses. And when companies start reporting losses, stocks get crushed. Look at Target's latest earnings report, one of America's largest retailers, and margin hovers around 3 to 4%. Now, compare that to major airlines like American Airlines or United. During challenging periods, they've run sub 1% margins, sometimes even lower. When you're that lean, there's no room for error. Fuel cost spike, margin gone. Supply chain hiccup, margin gone. Workers demanding higher wages, you're now losing money. And once companies start reporting losses, the debt becomes unmanageable. The spiral starts. The stock gets destroyed. Look, some industries have naturally lower margins than others. But if you're investing in a low margin industry, you better have a really good reason. Me, I mostly avoid them now. Why invest in a company keeping 1% of revenue when you can invest in one keeping 15% or 20%? Life's too short for 1% net margins. Now, red flag number 6 is different. This one is not a single ratio. It's a trend you need to spot. Go look at the last 3 or 4 years of financial statements. Look at revenue. Look at cost of goods sold, which is your direct costs. Is revenue growing? Good. But are direct costs growing faster? That's bad. Really bad. This tells you the company is losing pricing power. They can't raise prices enough to cover their increasing costs. Their margins are getting squeezed. Over time, this is fatal. Want to see this in action? Look at what happened to Target over the past few years. Pull up their financials from 2023 to 2025. You'll see revenue growth. People still need to buy everyday essentials. But dig into their cost of goods sold. Supply chain disruptions, higher freight costs, increased labor expenses, all of these hammered their direct cost hard. The problem? They're competing directly with Amazon and Walmart in an incredibly tight margin business. When customers compare prices with a few clicks, you can't just raise prices to offset your cost increases. Shoppers will absolutely switch to Amazon to save a few dollars on household items. The result? Gross margins that slowly compress. You see their operating margins get thinner year after year. The business isn't collapsing. It's just becoming less profitable with each passing quarter. Here's what you need to understand. In a healthy business, revenue should grow faster than costs. That's what's called operating leverage. As the company gets bigger, it should get more efficient. Margins should expand. Profits should grow faster than sales. When the opposite happens, when costs grow faster than sales, you have negative operating leverage. The bigger the company gets, the less profitable it becomes. This is death by 1,000 cuts. It doesn't kill the company immediately, but 5 years later, you wonder where all the profits went. How do you check the trend? Pull up the last 3 years of 10Ks and compare these line items from the income statement. Revenue and cost of goods sold, or COGS, side by side. Calculate the year-over-year growth rate for both revenue and COGS. If direct costs are rising faster than revenue for 2 or more consecutive years, it's a red flag. The business model is deteriorating. All right, last one. And this is probably the most important for avoiding total disasters like bankruptcy. Interest coverage ratio. This tells you whether the company can afford its debt payments. Calculate it by taking EBIT, or earnings before interest and taxes, and dividing it by interest expenses. If that number is below 1.5, the company is one bad quarter away from not being able to pay its debts. Here's why 1.5 is the danger threshold. Earnings are volatile. They go up and down. If you're only covering your interest payments by 1.3 times, and then you have a quarter where earnings drop 30%, suddenly you can't pay the interest. When companies can't pay interest, bad things happen fast. Credit ratings get cut, borrowing costs go up, covenants get breached, bankruptcy lawyers start circling. Look at what happened to Bed Bath & Beyond. In early 2022, their interest coverage ratio had fallen below 1.5x. The company was hemorrhaging cash, loaded with debt from years of buybacks and struggling operations. Their EBIT was barely covering the interest payments on their bonds. Then came a few bad quarters. Nothing catastrophic, just declining sales and margin pressure. Suddenly, they couldn't service their debt. Credit agencies downgraded them. Lenders tightened terms. By January 2023, they were in full crisis mode, scrambling for emergency financing. The stock went from $5 to under $1 in months. By April 2023, they filed for Chapter 11 bankruptcy. This is textbook death spiral, and the interest coverage ratio telegraphed it quarters in advance. Here's my rule now. If interest coverage is below 3, I want to see a really clear path to improvement. Debt being paid down, EBIT growing consistently. If it's below 1.5, I don't care how cheap the stock looks. I'm not touching it. Debt can amplify returns when things go well, but it magnifies disasters when things go bad. And I'm not in the business of betting on disasters anymore. You need to understand. Bad stocks don't show just one red flag. They show multiple simultaneously. That dry shipping stock I bought in 2008, let me tell you what the numbers actually showed. Gross margin, 11%, barely above our threshold. Revenue growth, 0%, flat. Net margin, 0.8%, less than 1%. Interest coverage, 1.4x, which was below 1.5x. 4 red flags, sitting right there in the 10K. And I ignored all of them because I saw a low stock price, mistook it for value. Look, I'm not a perfect investor or trader. I still make mistakes. But I don't buy or trade obviously broken businesses hoping for miracles. I check these 7 ratios before I invest or trade anything now. Takes me maybe 15 minutes, and even less with an AI agent. Those 15 minutes have probably saved me hundreds of thousands of dollars in losses over the past 5 years. Investing isn't about being smart enough to pick the next Amazon. It's about being smart enough to avoid the disasters, and the wins take care of themselves. So go check these ratios. Seriously, look at your current holdings. If you're holding stocks with 3 or 4 of these red flags, think hard about whether you want to keep them. Because the market will eventually figure out what you might already suspect. And by then, it will be too late. I'll see you in the next one. Stay smart out there.